Something massive just happened, and if you hold XRP or any crypto, you need to understand exactly what's going on right now, because this could change everything for the markets in the next few days. There's a deal on the table, oil is reacting, Bitcoin is moving, and the Fed is meeting this week, all at the same time. This is one of those rare moments where multiple major events are colliding at once, and knowing how to read it could make or break your portfolio. So let's break it all down clearly, calmly, and completely. XRP is currently sitting at around $1.80, and the moment the deal announcement came in, we saw it jump from approximately $1.13 up to around $1.19. That's roughly a 5% move. Now, before you get too excited or too disappointed, understand why it moved the way it did and why it didn't explode 20% overnight. This was not a drop everything and go wild moment for the markets. It was a measured, cautious reaction from smart money. And that actually tells you a lot about what traders think of this deal and how durable they believe it is. Bitcoin saw a similar percentage move, Ethereum moved similarly, Solana followed the same pattern. They all rose in roughly the same range, which tells you this is a macro reaction, not a coin-specific one. The entire risk-on market responded together, which is a key signal worth paying attention to. On the flip side, oil dropped on the news and is now sitting under $80 per barrel for the first time in a very long time. That is significant. Oil had spiked dramatically in recent months, and that spike was adding serious pressure to inflation. When oil is expensive, everything becomes more expensive. Transportation costs go up, manufacturing costs go up, food costs go up. So oil dropping is genuinely good news for the average person. And it's also good news for the Federal Reserve, which has been in a very tough spot trying to manage inflation without causing a recession. The drop in oil could give them just a little bit of breathing room heading into this week's critical meeting. Now let's talk about the deal itself, because the details here really matter. What we have right now is essentially a ceasefire extension, not a full peace agreement. The current terms commit both sides to a 60-day negotiation period focused on technical discussions around a nuclear program. During this time, the U.S. has agreed to remove the naval blockade and reopen the Strait of Hormuz, which is one of the most important shipping lanes in the world for oil and global trade. The U.S. has also committed to discussing sanction relief and the release of frozen funds. In exchange, there is a pause in active conflict, and the broader goal is to reach a final signed agreement by June 19th in Switzerland. That sounds promising on paper, but here is where things get complicated and why the markets didn't go into full euphoria mode. A ceasefire is not a peace deal. A ceasefire can break down. We already saw a previous ceasefire fail to hold, and there's no guarantee this one will be any different. Some analysts are already arguing that this deal represents more of a concession than a victory, pointing out that key power structures remain intact. The demands of internal protest movements were not addressed, and the question of whether a nuclear program will actually be dismantled remains completely unanswered. These are not small concerns. These are the exact kinds of unresolved issues that cause ceasefires to collapse after a few weeks. There's also the Lebanon question, which is particularly thorny. A truly comprehensive peace would require a halt to fighting on all fronts, including Lebanon. But right now, that front is far from settled, and the parties involved have shown little indication of slowing down. This creates a real tension in the agreement. You can call something a comprehensive deal, but if major conflict zones are still active, the credibility of the entire arrangement comes into question. Markets are smart enough to recognize this, and that's exactly why we're seeing a moderate positive reaction rather than a runaway rally. So is this deal a success or a failure? Honestly, it depends on your time horizon. In the short term, it's a relief rally. It reduces immediate geopolitical risk. It brings oil prices down. It gives the Fed more flexibility, and it reduces the chance of an economic shock in the next few weeks. In the medium term, it's fragile. There are 60 days of negotiations ahead, and anything can happen during that window. In the long term, 5, 10, 20 years from now, we genuinely don't know. History is full of agreements that seemed underwhelming at the time, but laid the groundwork for lasting peace. just as it's full of ceasefires that collapsed and made things worse. Time will tell. Now let's zoom out and look at the bigger picture for crypto specifically, because there are several other forces at play this week that could completely override the positive sentiment from this deal. The first and most important one is Japan. The Bank of Japan is expected to make a decision on interest rates, and this is not something to take lightly. Since 2024, the Bank of Japan has triggered 4 separate market sell-offs every single time they raised rates. March 2024, July 2024, January 2025, and December 2025. Each time Bitcoin pulled back, the stock market pulled back, and risk assets across the board took a hit. If Japan raises rates again this week, we could be looking at another significant pullback in crypto, potentially in the range of 20 to 30% based on historical patterns. That decision is expected Tuesday, and then the Federal Reserve meeting is Wednesday. That means Tuesday and Wednesday this week are potentially the 2 most critical days for the markets in recent memory. You have Japan's rate decision, you have the Fed, you have a geopolitical deal that might or might not hold, and you have a crypto market that has already been under serious pressure. The next 48 hours could genuinely set the direction for the next several weeks or even months. On the technical side, there are some encouraging signals for XRP specifically. Looking at the daily chart, XRP dropped all the way down to $1.40 during the recent sell-off, but did not break the $1 level, which is a major psychological and technical support zone. It bounced from there, and there is a potential double bottom formation developing, which is a classic bullish reversal pattern. On the 4-hour chart, we've seen a crossover on the 13/48 EMA. The green line crossed above the red line for the first time since mid-May. That kind of crossover, when confirmed, often precedes a sustained momentum move. It's not a guarantee, but it's a meaningful technical development that suggests buyers are stepping back in. The broader crypto market also bounced off the 60,000 level on Bitcoin, which is another key support zone. Asian markets were up around 4 to 5% overnight, broadly in line with what we saw in crypto, which again confirms this is a macro risk-on move driven by geopolitical relief rather than any specific crypto catalyst. One more thing worth mentioning is the current positioning in the crypto derivatives market. Right now, there are significantly more shorts than longs, which actually makes sense given how far the market has pulled back and how much negative sentiment has built up over the past few weeks. But here's the thing, when the majority of traders are positioned short and a piece of positive news hits, you get a short squeeze. We had a small squeeze on this deal news, but not enough to trigger a real breakout. However, if more positive catalysts stack up this week, a no hike from Japan, a dovish Fed, and continued geopolitical calm, the short squeeze potential becomes much more significant. A lot of fuel is sitting in those short positions, waiting to be ignited. Looking at best and worst case scenarios for the coming weeks, the best case is that Japan holds rates steady, the Fed signals flexibility or even hints at cuts, the ceasefire holds, oil stays low, and most importantly, the Clarity Act passes through Congress in the next month or so. If all of that comes together, crypto could see a meaningful rally into the end of the year. The Clarity Act in particular would be a landmark moment for the industry. It would remove the regulatory uncertainty that has been hanging over the crypto market for years and could unlock a wave of institutional and retail participation that the market has been waiting for. The worst case scenario is that Japan raises rates and triggers another broad market sell-off. The ceasefire breaks down within a few weeks, oil spikes again, the Fed is forced to stay aggressive, and the Clarity Act stalls or fails to pass. In that scenario, we'd likely see a deeper pullback across all risk assets, including crypto, and the road to recovery would be significantly longer. The realistic scenario is probably somewhere in the middle. Markets rarely deliver the perfect bull case or the catastrophic bear case. They grind, they test, they shake out the weak hands, and then they move. The key is staying informed, staying rational, and not making emotional decisions based on short-term price swings in either direction. Whether you're bullish or bearish on XRP, Bitcoin, or crypto broadly, what matters most right now is understanding the macro environment, watching the key catalysts this week, and positioning yourself accordingly based on your own risk tolerance and investment goals. The next few days will tell us a great deal about where this market is headed for the rest of 2026.